So we talked about adding an individual. Withdrawing a partner, partnerships can withdraw. Um, Generally speaking, all of this needs to be spelled out in the partnership agreement describing how a partner withdraws, and just what the guidelines are. So basically, in withdrawing, the partner can sell his interest to the remaining partners or sell it to a new partner. The partner can withdraw his interest in the partnership assets. So when partners sell his or her interest to another partner or to an outsider, that transaction is going to be personal, and it's really not going to change the partnership assets or partner's equity. So let's take an example of this. The capital balances of mine, Padilla, and Novak are 140, 100, and 60,000 respectively, for a total of 300,000. Padilla wants to withdraw from the partnership and is reviewing two offers for her interest. The offers are: number one, to sell her interest to Novak for 110,000, or to sell her interest to Mary Smith, a new person, for 120,000. The remaining partners have agreed to either transaction. Because Novak and Smith would pay for Padilla's interest from their personal assets, the partnership accounting records would show only the transfer of Padilla's interest to Novak or Smith. So as we look here, if Padilla's interest gets purchased by Novak, then what we do is Padilla would decrease her capital account 100,000. Novak's capital account would increase 100,000. Or if Mary Smith comes in, Rose Padilla's capital account is decreased 100,000, and a new partner comes in, Mary Smith, her capital account is increased 100,000. If the partnership can allow a withdrawing partner to remove assets equal to his or her capital balance, then it will change the partnership. This will affect the partnership's assets. Adam decides to withdraw from the partnership. The partnership agreement states that he can withdraw cash from the firm equal to his capital balance. If there's not enough cash, he must accept a promissory note from the partnership. The remaining partners ask that Novak take only 50,000 because of a cash shortage, and he agrees. So in this case, Novak, we're going to get rid of his capital account by 60. We're going to show cash taken out as a credit of 50. And then we're going to have a note payable to Adam Novak for 10. Since Adam's no longer a partner, the partnership entity has changed. The separate entity now only has two partners in it. Now, withdrawals aren't always equal to the partner's capital account. This usually happens quite often. So when that partner that's withdrawing removes assets that are less than his or her capital balance, the equity that a partner leaves in the business gets divided among remaining partners. And then when withdrawing partner takes out assets that are greater than his or her capital balance, that excess gets treated as a bonus to the withdrawing partners, and as a result, those partners that are remaining, their capital balances are going to be reduced. When partners die, then again, that partnership has to be dissolved because it is not in that form anymore. Usually, determining how much is given to the estate of that dying partner is determined by closing out the business and determining those balances at the date of death. So let's look at another example here. Let's go to let's go back here to E7A. Let's admit a new partner. Gamine, Ronald, and Fenny have equity in a partnership of 80,000, 80,000, and 120,000 respectively, and they share income and losses at a ratio of 1 to 1 to 3. The partners have agreed to admit AMIT to the partnership. Prepare journal entries to record the admission of AMIT under the following conditions. So right now we've got 80,000, 80,000, and 120,000 as the capital balances. AMIT in number 1 invests 120,000 for a 20% interest in the partnership, and a bonus is recorded to the original partners. So he is investing 120,000 for a 20% interest in the partnership. So what we're going to do is now calculate the new capital balance of the partnership by the 80, the 80, the 120, and add the 120 to come up with a 20% investment here. So E7, let me go down here. So what we're going to do, $120 is going to be increase the cash, and basically the way we figure out the new percent, the 80, the 80, and the 120 was 280,000 in the capital balances of the 3 partners. The 120 that AMIT is adding has a new capital balance or equity in the partnership of 400,000. 20% of this 400,000 is 80,000 is going to be the capital account for AMIT. So we see here AMIT's capital account, even though he invested 120, 80 of it is his capital into the company. Now we know the difference, or the additional 40,000 gets allocated 1 to 1 to 3. And so the difference of this 40,000, we know Gaiman has 1 out of 5, or 20%, gets allocated to Gaiman. So 40,000 times 20%, or 8,000, is going to be allocated to Gaiman. Ronald has 1 to 1 to 3, or 20% of the 40,000 gets allocated to Ronald. Fenny has 3/5 of the allocation. So 3/5 of 40%, or 24,000, is going to be allocated to Fenny. So the cash of 120,000 that came into the partnership, Gaiman's capital account is going to increase 8. Ronald's is going to increase 8. Fenny's is going to increase 24,000. So AMIT ends up with a 20% investment in the partnership, and that additional 40,000 of cash is going to be allocated among the other partners. Okay, number 2 states AMIT invests 120,000 for a 40% interest in the partnership, and a bonus is recorded for AMIT. So this is an example where they really want him in the partnership, and they're willing to give of their own capital to have him in the partnership. So in this case, we have to allocate 40% of 400,000, or 160,000, is going to be the capital account for Amit. So we show cash of 120, and we're going to show Amit's capital account of 160. Now, we need to allocate that 40,000 among the other partners. So 20% of that 40,000, or Gaiman reduces his capital account by 8, Ronald reduces his capital account by 8, and Fenny reduces his capital account by 24,000. So in order to give Amit 40% of the business, they each have to give up a piece of their capital in order for him to have a capital balance of 160,000. So again, by adding a new partner, it can vary just based on what the agreement is. If the partnership is doing very well, then the partner, the new added individual, is going to be paying additional to the existing partners. If they really want a partner to come in, then what will happen is they may have to give up a portion of their capital in order to get that new partner. Let's look at withdrawal of a partner. On E8A, it says Sam, Richard, and Tom are partners. They share income and losses in the ratio of 3-to-1. So basically, Sam has 50% of the business. Richard looks like he has a third of the business, and Tom has 1/6 of the business. Tom's capital account has a $240,000 balance. Sam and Richard have agreed to let Tom take $320,000 of the company's cash when he retires from the business. What journal entry must be made on the partnership books when Tom retires, assuming that a bonus to Tom is recognized and absorbed by the remaining partners? So if Tom has a capital account of $240, but he's going to get to take $320,000 of cash from the business, then we're going to debit his capital account by $240, and that remaining $80,000 is going to have to be shared by Sam and Richard. So as you see here, the $320 in cash, we know $240 is Tom's capital account we need to zero out. But that difference, that $80,000 difference, will be allocated 3/5 to Sam and 2/5 to Richard, or $48,000 is going to reduce Sam's capital account, and Richard's will be reduced $32,000 in order to give Tom that bonus that they want to give him to get rid of him. Oftentimes, in this kind of case, they really want this partner out, and they're willing to pay an additional amount just to, or also for him to receive some of the benefits from the company over the period of time. Okay, let's go back to the PowerPoint here. And now we're going to talk about totally liquidating the partnership. So liquidating the partnership is selling enough assets to pay the partnership's liabilities and distributing any remaining assets among the partners. So it's basically dissolving the partnership. So as you see here, assume the books have been closed for this partnership and that the following balance sheet exists before liquidation. The stated ratios for mine, Padilla, and Novak are 3:3:4 respectively. So 3 plus 3 plus 4 is 100. That would be 100%. So Mind has 30% of the business, Padilla has 30%, and Novak has 40% of the business. or that's how the ratios are shared. So as you see here, we've got the various assets of 400,000. There are liabilities of 120, and the equity accounts 85, 95, and 100. So let's see how this is going to be liquidated. The following transactions take place. On February 13th, the accounts receivable were collected for $35,000. On February 14th, the inventory was sold for $110,000. On February 15th, the plant assets were sold for $200,000. On February 16th, the accounts payable of $120,000 was paid. On February 20th, the net gain of $5,000 from the realization of the assets was distributed according to the partners' stated ratios. And then on February 20th, the partners received cash equal to the balances of their capital accounts. So we're going to record these various transactions. For the accounts receivable to be collected, $35,000 is the cash for the accounts receivable. The gain or loss from realization is going to be a loss of $5,000 because our accounts receivable were $40,000. We basically received 35 of the 40, so we have a loss from the realization of zeroing out our accounts receivable. Then the inventory was sold. The inventory was valued at, or excuse me, was listed on our books at $100,000. We sold it for $110,000. So as you see, we have a gain from selling the inventory of $10,000. So our cash was debited at $110,000. Our merchandise is no longer, so we're going to credit that merchandise. And then our gain or loss from realization of $10,000, that's going to be a gain from the sale of the inventory. Now let's look at the plant assets. We have cash of $200,000. Plant assets had a book balance of $200,000. Those just get zeroed out. Same with our accounts. Now our accounts payable, we paid them off. We debited accounts payable, credited cash to zero it out. Now the gains or the losses from the accounts receivable and the inventory are going to be allocated to the various partners. The $5,000 is going to be allocated 30, 30, 40. So 30% gets allocated to Lori, or actually this was a gain from the realization here. $1,500 is going to Lori, Rose is getting $1,500, and Sam gets 40%. Oh, this is the distribution on the net gain of assets minus the $5,000 loss to the partners. Okay, so the accounts receivable had a $5,000 loss. The inventory sale had a $10,000 gain. The net amount is a $5,000 gain, which is going to each of their capital accounts. Now, the cash sitting in the books of $285,000 is going to be allocated to Lori, Rose, and Adam based on their allocation of 30, 30, 40. And if I can see correctly, I believe we're trying to zero out their capital accounts. If we have 285,000, let me look here. Right now we have Mind has a balance sitting in the account of 85,000. We add that 1,500, so Mind has 86.5 left, or as a capital balance. Padelia has 96.5, and Novak has 102,000. So there's enough money in the cash to zero everybody's account out. So the 285,000 in cash basically then, in this case, wipes out everybody's capital account. So we didn't have to take that cash and allocate it accordingly. I apologize for that. That's based on income or gains or losses. But in dissolving the account, we're going to clear out their capital accounts. And in this case, the capital accounts totally equal the cash left over. So as you see from this worksheet, with allocating the gain, that $5,000 gain, to each of the partners, there was available cash to zero out everybody's capital account. Let's take a look at another problem. So let's look at E9A. Assume the partners the following assets, liabilities, and partners' equity in the Winner and Perry partnership on December 31st are assets of $320. The liabilities are $20. Winner has a capital account of $80, and Perry has a capital account of $120. The partnership has no cash. When the partners agree to liquidate the business, the assets are sold for $240,000 and the liabilities are paid. Winner and Perry share income and losses in a ratio of 3-to-1. So we're going to prepare the liquidation and the journal entries here. So again, the $320,000 in assets are sold for $240,000. The liabilities get paid off, and any income or losses get allocated 3-to-1. So let's look here. Let's see how I can rotate clockwise. So in this case, as you see here, the assets were $320. They sold for $240. We had debt of $20. So the cash left is $220,000. Our liabilities are paid off. We have a capital account of $180. We have a capital account here of $120. We have a loss from the sale of the assets of $80,000. So we're going to need to allocate this $80,000 loss among Winner and Perry. Winner is going to take 75% of this loss, and Perry's going to take 25% of the loss. So after we allocate that loss to the two partners, the new balance for Winner is $120. The new balance for Perry is $100. We then have the $220,000. We can allocate the $120 to zero out his capital account, and the $100,000 to zero out Perry's capital account. Now, as you see here, on this one, on this particular slide, we're showing the journal entries. So the cash we received from selling the assets of $240 end up with a loss from realization of $80, and we have to wipe the assets off our books. Since it was a debit of $320, we need to zero that out for a credit of $320. Then we paid off the liabilities. So we debit the liabilities for $20, credit our cash for $20. Now we need to allocate that $80,000 loss among the two partners, 75-25. And then after that, we show reducing their capital accounts to zero and distributing the cash. So that is the real culmination of the important aspects of this chapter. I want to now, let's go and look at a couple more of your homework problems. So we did P1. I'm going to let you do P2 on your own because that we went over some problems and you have the solutions in D2L to help you with that. I think my, we're having such bad rain, I think my internet is slowing down. What I want to do is go over P4 with you because that's probably the most challenging. So that's the one I'd like to spend our time right now going over. The homework will be P1 through P5, and we did P1. I'm going to do P4 now. Josh, John, and Hassan are partners in a retail lighting store. They share income and losses in the ratio of 2 to 1, respectively. The partners have agreed to liquidate the partnership. The partnership balance sheet before the liquidation follows. So we have cash of $280, other assets of $880. We have accounts payable of $360 and their capital accounts. The other assets were sold on September 1st for $720,000. So we see $880 are the other assets. If they were sold for $720, then that means there's a $160,000 loss or loss from realization. Accounts payable were paid on September 4th, and then the remaining cash is distributed. So our requirement is to prepare the statement of liquidation and then prepare the journal entries for all those events. So as we go down here, as you see here, the statement basically shows us that the cash was $280, the other assets were $880, the accounts payable $360, and here are the three capital accounts for the partners. The assets were sold for $720, but the assets are valued at $880, so $160,000 needs to be allocated among the partners. As you see, the partners' allocation, I believe, oh boy, let me look. I can't remember. The partners' allocation 2 to 1. So 2/5 is going to be allocated as the loss to Josh, 2/5 to John, and 1/5 or 20% to Hassan. So this loss of 160, 2/5 is going to be distributed to Josh, 64,000. 2/5 or 64,000 is distributed to John, and 20% is distributed to Hassan. So their new capital balances are the 400 minus the 64, 336, the 240 minus 64, 176, the 160 minus 32, or 128. So going back to the cash, we began with 280. We added 720 for $1 million. We're going to take 360,000 of this money and pay off our debts. We have remaining 640,000. This 640,000 is sufficient to pay each capital account and bring it down to zero. Now, as you see on this slide, the journal entries will show you, oh, this just shows you the journal entries here, the cash of 720, the loss from the sale of the assets of 160, and we're going to wipe out the other assets from, or zero it out from our balance sheet by crediting it. We then are going to pay off our accounts payable. So we debit our accounts payable, we credit our cash. We distribute the loss, 40%, 40%, and 20% by reducing the capital accounts, that loss. Then from there, the distribution of cash. We have $640,000 of cash that we can distribute, and each of the capital accounts is zeroed out there. So in a nutshell, we have pretty much handled everything that I want to cover for this chapter. I'm not going to get into more details of when liquidations create a greater partner balance. We're not going to worry about that. So your homework will be P1 through P5, and I will have the solutions online. I will have problems for your Chapter 11 quiz available for you to complete. Chapter 11. And if you have any questions, you guys know, feel free to email me. And I will see you guys next week in class. Take care. Bye-bye.